Hello everyone. Today we start with the last chapter of your accountancy syllabus, that is insurance company accounts. Now what is insurance? We are already aware of it. Since past so many years we have been studying it, that life is full of risk and uncertainty. So to cover that loss of risk, to cover the damage, we have insurance company. Okay. We pay certain sum of amount to insurance company every year in the form of premium, against which they give us the guarantee to compensate us whenever we face loss or damage in future. So insurance company indirectly protects us against those risks and uncertainties. However, what we are going to study in this chapter is not the concept of insurance. What we are going to understand in this chapter is how to make final accounts for insurance company. So before we start with the formats of final accounts and what all things are included in final accounts, let us have a brief introduction in the types of insurance businesses. There are mainly two types of insurance, we already know. First is life insurance and second is general insurance. Life insurance covers the life of a person, that is risk of death. So if the main income earner, generally the main income earner of a family should take life insurance, so that if anything happens to the main income earner of the family, then whatever is the policy amount, say you have taken a policy of 1 crore. So if the main income earner dies, then the nominee or the legal heirs or family members of that deceased person who has died would receive that sum of 1 crore from the insurance company, which would financially support the family members for the rest of their life. That is the basic concept of life insurance. And general insurance covers the risk of damage of house, vehicle, health, fire, accident, marine, etc. Everything other than life is covered in general insurance. Now all of you take out your notebooks and give the heading insurance company accounts, and whatever portion I tell you during this video lecture, you are supposed to write it in the notebook. Okay, I repeat it, whatever I tell you, you will only write. Don't write everything you are coming across in this video lecture, that would be too lengthy. Important points which I make you write, only you are supposed to write in the notebook. So going further, we first understand the basic terms of insurance, because until and unless you understand the basic terms of insurance, when we make final accounts, you will not be able to differentiate, is it an income for the insurance business or an expense. So understanding the concept of these terms is very important. Then and then only you'll be able to differentiate, when we make final accounts, is it an income or an expense. So give this heading in your notebooks, everyone, basic terms of insurance. In that first term, all of you write down premium. Now everything is not to be written because you are already aware of what is premium. So you need not write that again in your notebooks. Okay. See, it refers to the consideration received by insurance company in consideration of the risk undertaken by it. Okay. As an insured, we pay certain sum of money to insurance company to protect us against the risk of damage and loss. That money paid by us to protect us is called premium. Now, from insurance company's point of view, what is this premium? It's an income. I repeat, from insurance company's point of view, what is this premium? It is a major income for insurance company. Read it further. In case of life insurance, the premium received is to be shown under two subheadings in the revenue account. A is first year's premium. It is the premium paid by policyholder in the first year of the life policy. And B is renewal premium. They are the premiums paid by the policyholders in the later years. In case a policyholder pays all the premiums in lump sum, that is one time only, it is referred as single premium. In your notebooks, all of you write down this portion, that premium will appear as major income in revenue account. I repeat it. In your notebooks, all of you write down, premium will appear as major income in revenue account. Further, you all write down this highlighted portion, that for life insurance company, premium is shown under two subheadings. first premium and renewal premium, and note down that last sentence also. If policyholder pays all the premium in lump sum, it is referred as single premium. You can pause the video and note down this highlighted part. Going further, the second important term in case of life insurance or general insurance business is commission. Insurance companies pay commission to their agents who bring business to them. Such commission is termed as direct commission. So we all understand the meaning of commission. Insurance company gives commission to the agents who bring the business to them. For the insurance company, it's an expense. So you all just write this much portion in your notebook, that commission will appear as major expense in revenue account. All of you write down this in your notebooks. Commission will appear as major expense in revenue account. Going further, the third term for insurance company is annuity. Now this is an important term, annuity, new term for you people. Yes, but in financial management, if you would have already done time value of money, then you are aware of what is the meaning of annuity. So annuity means annual payment. In simple language, annuity means annual payment. The life insurance corporation or company guarantees to pay a certain sum of money regularly as long as the insured lives, in consideration of a lump sum of money received in the beginning. The amount paid is termed as annuity. Before I read it further, all of you look at this short video to understand the concept of annuity. One time premium you pay. So you pay, let us say, at the age of 60 years, 50 lakh rupees to the insurance company. So you make one time payment to the insurance company, against which every year until your death, insurance company will give you annual amount which is called annuity. I repeat, at the age of 60 years, you make one time premium payment to the insurance company, say suppose 50 lakh rupees. Against that, until your death, every year insurance company will pay you certain sum of money, and you can opt to get that amount monthly also, half yearly also, quarterly also, or once in a year also. Okay, so basically either you build your own pension with your annuities. That premium can be paid either in lump sum or in installments. You can decide that right now, if you are 35 years of age, between 35 years to 60 years of age, you will pay premium to the insurance company, and then whatever is accumulated amount at the age of 60, based on that, until your death, insurance company will pay you certain amount every year. And many times, if you die, then your family members also receive that amount until they die. That is the concept of annuity. Now, further, if you read it at the top, you can see in the paragraph, it appears as an expense in the revenue account in yellow highlighted. And the consideration received by the corporation, that is that 50 lakh rupees which you pay at the age of 60 years. That consideration received by the corporation is termed as consideration for annuities granted, and it is treated as an income in the revenue account. So first of all of you write down this yellow highlighted things in your notebook, that annuity means annual payment. It appears as an expense in the revenue account. And then you write down this green highlighted one. The consideration received by the corporation or the insurance company is termed as consideration for annuities granted, and it is treated as an income in the revenue account. Again, I have highlighted that annuity paid will be shown along with claims or benefits paid in revenue account. Write down this in the next paragraph. Particularly when you show it as an expense, where would you show it as an expense? You will show it along with claims or benefit paid in revenue account. Write it down, it will help us to understand the formats later on. And consideration for annuity granted will be shown along with other incomes in revenue account. Write down this also. Consideration for annuity granted will be shown along with other incomes in revenue account. Okay, in case if you have not written, you can pause the video and write down this yellow highlighted, green highlighted, and the one shown in black background also. And then we proceed to the next slide. Going further, the fourth term is reinsurance. Now this is again a different term. First time you might have heard it, reinsurance. Reinsurance means transferring the whole or a part of the risk undertaken by the insurer to another insurer. Reinsurance is usually resorted to in those circumstances where an insurer feels that he has undertaken a larger risk than what he can bear. Both reinsurer and the original insurer share the premium in the proportion to the risk undertaken by them, and they also bear the loss in proportion to their risk. The amount of premiums and the claims are shown in the revenue account after making adjustment for premium received or paid and claims admitted or recovered under reinsurance contracts. Reinsurance is possible both in case of life and general insurance. However, it is more popular in case of general insurance. I'll explain it to you in detail again, but first you have a look at this short video to understand reinsurance.
When an insurer is offered a very large or very hazardous risk, they may feel that it puts their own pool of money in jeopardy. When this happens, they can transfer the risk in exactly the same way individuals and companies do. They do this through reinsurance. Essentially, reinsurance is insurance for insurers. Let's take a look at a simple example of a reinsurance agreement. A policyholder takes out cover with an insurer. The insurer is responsible for covering 100% of any claim costs, and the policyholder pays 100% of any premium owed directly to the insurer. However, the insurer can't or doesn't want to accept all of the risk, so they pass 40% of it to a reinsurer. This means they pay the reinsurer 40% of the policyholder's premium. If a claim is made, the insurer will pay 100% of the claim directly to the policyholder, but will be able to recover 40% of the claim costs from the reinsurer.
Now, understand through this video what it was trying to say. If one insurance company takes certain risk and then later on they find that they've taken a huge risk, and if compensation comes, it may be very difficult for them to bear that risk and pay the compensation to the insured. Then what the insurance company does is they pass on their certain amount of risk to another insurance company. That's why in the video also it was said, what is reinsurance? Insurance for insurer. I repeat, insurance for insurer. So let us say you take your insurance with HDFC Ergo. You insure your house of 5 crores with them. Later on, the HDFC company finds that they have taken a huge risk of insuring 5 crore. Then out of that 2 crores of risk, they pass on to ICICI Prudential Company. This is called reinsurance. Insurance for insurer means HDFC further out of 5 crore, 40% amount, 2 crore of risk they pass on to ICICI. You may not be aware of that. It is a transaction between those two companies. You have to deal with HDFC only. But HDFC has taken a reinsurance with ICICI. Now, whatever premium you are paying to HDFC, out of that 60% premium, that is 3 crore related policy, HDFC will keep with themselves. And remaining 40% premium that is related to 2 crore of policy, they will pass on the premium to ICICI. In the same manner, whatever commission is to be paid to agents every year, 60% will be borne by HDFC, 40% by ICICI. And when any compensation or claim arises, at that time also, 60% HDFC will bear and 40% ICICI will bear. You will take entire money from HDFC only, but HDFC in turn will take 40% money from ICICI. Okay, so basically it is what you can see in the first pink umbrella. one company has taken the risk of two people and then they are needing the support of blue umbrella to help those two people, otherwise all the three will fall. So that pink umbrella is HDFC company, which further needs support of blue umbrella, that is ICICI company. Now there are two terms used for that. This pink umbrella HDFC company is called reinsurance ceded. I repeat, reinsurance ceded. It means passed on to other insurance company. Reinsurance ceded will always be subtracted. Okay, and this blue umbrella ICICI company, it is called reinsurance accepted, means taken from other insurance company, and reinsurance accepted will always be added. So all of you note down this in your notebook. First you note down the yellow highlighted part in your notebook, that reinsurance means transferring the whole or part of the risk undertaken by insurer to another insurer. And then both reinsurer and the original insurer share the premium in the proportion to the risk undertaken by them, and they also bear the loss in proportion to their risk. Then in the next paragraph you note down that reinsurance ceded means passed on to other insurance company, and more importantly underline and write in capital letters that reinsurance ceded will always be subtracted. Whether it is a case of premium on reinsurance ceded, or it is a case of commission on reinsurance ceded, or it is a case of claims on reinsurance ceded, wherever ceded comes, you will minus. I repeat, wherever ceded comes, you will minus. Note down this, very important. Then in the next paragraph, you all write down reinsurance accepted means taken from other insurance company, and reinsurance accepted will always be added. Whether it is premium on reinsurance accepted, you'll add it in premium. If it is commission on reinsurance accepted, you'll add it in commission. If it is claims on reinsurance accepted, you'll add it in claims. Wherever the word accepted comes, you will plus. Wherever the word ceded comes, you will minus. If you have not noted down, then you can pause the video and write it down. Going further, fifth term is bonus. Now, there are two types of policies which the insurance companies issue. One is with profit policy and the other is without profit policy. With profit means with bonus policy. It includes bonus. Without profit policy means it does not give any bonus. Whatever profits insurance companies earn, some amount of that profit they give as bonus to its own policy holders if they have taken with profit policy. Look at this explanation given over here. A life insurance policy may be with profit or without profit. The holder of a without profits policy is entitled to receive on maturity only the amount specified in the policy. But on a with profit, he is entitled to receive in addition the amount of bonuses declared on each valuation. On each valuation, the amount standing to the credit of life fund, which is in excess over the net liability as determined by the actuary. Actuary is the person who estimates who will die at what particular age. So whatever is the excess, that is distributed amongst the shareholders and the policyholders. The share of policyholders is paid to them as bonus, either in cash on declaration or by reduction of future premiums on maturity of policy. Now, which are the different types of bonuses? Understand it. One is reversionary bonus. Reversionary means it is payable only on the maturity of the policy together with the policy amount. The other is bonus in reduction of premium. Bonus in reduction of premium means there is no point That insurance company first gives you the bonus and then you again pay the premium to the insurance company. So what does the insurance company do? They adjust the bonus with the amount of your premium. So if you have to pay the premium of 15,000 to the insurance company has to give you bonus of 12,000, then you will pay to the insurance company only 3,000 rupees. I repeat, if you have to pay premium of 15,000 to the insurance company has to give you bonus of 12,000, then instead of first you paying 15,000, then they giving you back 12,000, you will pay only 3,000 to the insurance company. This is called bonus in reduction of premium. This refers to the bonus which is payable in cash, but which is utilized by the policyholder to adjust the premium due from him. The amount of such a bonus is to be shown separately in revenue account as an expense, and the premium income should also be shown after giving due credit to the premium account for the bonus utilized in reduction of premium. First of all of you pause the video and write down the yellow highlighted portion. Write down, the holder of with profit policy is entitled to receive in addition the amount of bonuses declared on each valuation. The share of policy holders is paid to them as bonus either in cash on declaration or by reduction of future premiums on maturity of policy. Then you all directly write down in the next paragraph that bonus in reduction of premium, the amount of such bonus is to be shown separately in revenue account as an expense, and the premium income should also be shown after giving due credit to the premium account for the bonus utilized in reduction of premium. In short, you will remember this final point, which you all write down as a note, that bonus will appear as an expense in revenue account. I repeat, write down this in your notebooks. Bonus will appear as an expense in revenue account. And regarding bonus in reduction of premium, remember two things. Write down in your notebook. If bonus in reduction of premium is given in trial balance, I repeat, if bonus in reduction of premium is given in trial balance, then it will have single effect only, that is, it will be shown as an expense. As we discussed, that bonus will appear as an expense in revenue account. However, if bonus in reduction of premium is given in adjustment, then it will have two effects. First, you add it in incomes as a premium income, and then you also show it as an expense along with bonus. So as we have discussed in that yellow highlighted in bonus and reduction of premium, after giving due credit to the premium for the bonus, that is what it means. Add in income as a premium income, because you are receiving only 3,000 rupees as premium doesn't mean premium is 3,000. Premium you will show 15,000. So in that you'll add 12,000 also. And then 12,000 you'll show it separately as an expense also. So note down all these highlighted parts. If not noted, then you can pause the video and write it down. Going further, sixth term, claims. Now claims, you need not write all these so many things in detail. You all already understand what is claims. If any damage takes place, if the person dies, then the insurance company has to pay the amount of claim. So claims refer to the amount due by the insurance company to the various persons who have suffered loss on account of the events insured against. You just write down this yellow highlighted part. This is an item that appears as expenditure in the revenue account of an insurance company. Claims can be classified into the following four categories. First, claims intimated, accepted and paid means the customer has intimated the claim to the insurance company. Company has admitted and accepted also and paid also. Second, claims intimated, accepted but not paid. Customer has intimated the claim. Company has accepted the claim by 31st March year ending, but amount is not yet paid to the insured. Third, claims intimated but not yet accepted and paid. Client has intimated the claims to the insurance company. but insurance company's surveyor has not given the final report and they are yet to be accepted and paid. And last is claims rejected. First three, A, B and C, all the three will be shown as an expense in your revenue account. It should be noted that the claims intimated are taken at par with claims intimated and accepted but not paid. Thus, while ascertaining the outstanding claims, claims which have been intimated, whether paid or not, are to be considered. Now, in case of life insurance, we have claims by death and claims by maturity depending on the policy. If you have taken a policy of say 50 years and after 50 years if you are alive, then you will get the amount of policy on the maturity itself, and before 50 if the person has died, then his family members will get the amount on death. So for life insurance, claims may be by death or by maturity. A, claims by death, it refers to the amount paid on account of death of the insured. B, claims by maturity, it refers to the claims paid by the corporation on the policy holder reaching the age mentioned in the policy. This is possible in case of endowment policies where money is payable upon the policy holder reaching the age mentioned in policy. Anyway, you just note down this yellow highlighted part that this is an item that appears as an expenditure in the revenue account of an insurance company. So claims will appear as major expense in revenue account. Now, seventh term, surrenders. This term is used in case of life insurance business only. In case, if, not of, make it if policyholder is not in a position to pay, insert the word pay, the future premium on his policy, he may surrender his rights under the life insurance policy to the life insurance corporation or company. The corporation or company will pay him the surrender value of the policy as per the rules of the corporation. The amount so paid appears as an expense under the heading surrenders less reinsurance in the revenue account. See, many times it happens that you want to surrender your life insurance policy. You start paying the premium at the age of 30. After you reach the age of 45, your policy is up till the age of 60. But after you reach the age of 45, you find that now you don't want to pay the premium. You cannot pay the premium. You cannot afford to pay the premium. Your incomes have stopped. Now, since 30 to 45, 15 years, you have already paid the premium to the insurance company. Insurance company must give you some amount for that at least 15 years. For next 15 years until the age of 60, you cannot afford to pay the premium. So at whichever stage you surrender the policy, until that point, whatever amount of premium you have paid to the company, on the basis of that, insurance company will give you the surrender value. For the insurance company, this surrender is as good as claim because you have abandoned the policy in between and claimed that money from insurance company. So what will insurance company will do with this surrenders? Insurance company will show this surrender as claim as an expense in revenue account. So you all write down this all yellow highlighted part. In case if policyholder is not in a position to pay the future premium on his policy, he may surrender his rights under the life insurance policy to the life insurance company. The amount so paid will appear as an expense under the heading surrenders less reinsurances in the revenue account. And further in the next paragraph, write down that surrenders will appear along with claims. I repeat, surrenders will appear along with claims as an expense in revenue account. So all the basic terms of insurance company are covered. Now we are in a position to understand the formats of insurance business. You will be covered with two types of formats, one for life insurance, the other for general insurance. Today we will take up with the formats of only life insurance company. I repeat, today we will take up with the formats of only life insurance company. Once you remember these formats, in the next lecture, we will solve the questions related to the life insurance company final accounts And then after that, in the next lecture, we'll understand the formats of general insurance company. So in your notebooks, after the terms, all of you give the heading Part 1, Life Insurance. I repeat, in your notebooks, after the basic terms, give the heading Part 1, Life Insurance. You don't have to write this whole paragraph, just be attentive. Insurance carrying on the life insurance business should comply with the requirements of Schedule A. For life insurance companies, there is Schedule A. For general insurance companies, there is Schedule B. I repeat, for life insurance companies, there is Schedule A. For general insurance companies, there is Schedule B. Of the regulations, which, among other things, gives the following forms. Revenue account is to be prepared in Form A of revenue account, that is RAR stands for revenue account. P&L account, profit and loss account, is to be prepared as per Form A PL, where PL stands for profit and loss account. Balance sheet is to be prepared as per Form A BS. But only Form A RA, that is revenue account, is covered in your syllabus. I repeat, only Form A RA, revenue account for life insurance company, is covered in your syllabus. Profit and loss account and balance sheet is not included in your syllabus. The life insurance company is required to prepare revenue account and balance sheet in summarized form. However, there are 15 schedules, like we had scheduled in banking company account also. Okay, 15 schedules we had over there also, in fact 16. Here we have 15 schedules. 4 relate to revenue account and 11 schedules relate to balance sheet, giving detailed information. But as I said, only revenue account is covered in your syllabus, means only 4 schedules are covered in your syllabus. All insurance companies are to close their annual accounts on 31st March every year. So all this is not to be written in your notebook. You directly write down in your notebook. First, we understand the overview or format items of revenue account. Okay, first we understand the overview of format items of revenue account. So in your notebook, all of you make this chart that your revenue account will consist of 3 parts. This page is very important. Entire format of revenue account is based on this page. If you remember this page, then only you'll be able to remember the format. In this, I'm not going to give you any shortcut or trick to remember. This page itself is the trick to remember. This logic concept, what we are doing in this page itself, is the trick to remember. That revenue account has 3 parts. All of you show this in your notebook. 3 parts are there in revenue account. First part of revenue account will show 3 major incomes. Remember this? First part of revenue account will show 3 major incomes. Now you all try to recollect whatever 7-8 terms we have done up till now. What was the major income for the revenue? What was the major income for the insurance company? Come on, try to recollect. What was the major income for the insurance company? Yes, premium. So first major income that will come in the first part of revenue account will be premium. Now, what does the insurance company do with all the premium they receive? Do they keep it in their bank, locker, in the drawer? Obviously, no. They would invest it somewhere until the claims arise. So when they invest it somewhere, they'll also earn income from investments. And other than that, whatever incomes they are earning, they come in the category of other income. So very simple. First part of revenue account will show incomes, and it will show 3 major incomes: premium income, income from investment, and other incomes. I repeat, first part of revenue account will show 3 major incomes, which will include premium income, income from investment, and other incomes. Second part of revenue account will include 3 small expenses. Okay, second part of revenue account will include 3 small expenses. Which are the small expenses? Commission. We studied just now in the various terms. Commission is an expense for the insurance company. Other than commission, operating expenses, salaries, contribution to provident fund, printing, stationery, electricity bill, telephone bill, all these normal expenses are operating expenses. They are small expenses. And provisions, provision for tax, provision for depreciation, provision for bad debts. all the kinds of provision. So you remember three parts of revenue account. First part, three incomes: premium, income from investment, other incomes. Second part, three expenses: commission, operating expenses, and provision. And third part of revenue account will show three big expenses. Which are the big and main expenses for insurance company? Claims. Claims are the bigger amount, because suddenly if person dies, straight away 1 crore is to be paid. If your car meets with an accident, directly 40 lakhs, 50 lakhs. If car is stolen, maybe 10, 12 lakhs is to be paid. So these are big expenses for the insurance company. So in the third part, all the big expenses will come. Which big expenses? Claims. Then bonus. Whatever profit insurance company earns, crores of rupees, in that some part, again which is in crores, is to be given as bonus. So that is a big expense. And liabilities. Every year, particularly in case of life insurance companies, actuary will estimate that in the next year how many people may die, and accordingly what liabilities may have to be payable. So insurance company keeps a provision of those liabilities, which is again a very big amount. It is as good as claims which may arise in immediate next year. So three parts of revenue account, and every part three items are shown. Three is very important in this format. You have seen everywhere. 3 comes. Three parts of revenue account, and every part shows three things. First part shows three major incomes. Second part shows three small expenses. Third part shows three big expenses. Which three major incomes in the first part? Premium, income from investment, other incomes. Which three small expenses in the second part? Commission, operating expenses, provisions. Which three big expenses in the third part? Claims, bonus, and liabilities. If you remember this diagram, you remember the format. I repeat, if you remember this diagram or chart, you remember the format. So now we take up with the format of life insurance company. Give the heading in your notebooks, revenue account format. Further write down Form ARA. Just now we studied that life insurance company is covered under Schedule A. General insurance company is covered under Schedule B. So write down Form A-RA. RA stands for revenue account. Revenue account of ... insurance company for the year ended ... Same like banking final accounts, 4 columns will have to be made. Particulars, schedule number, amount. Make 1 page format. Pause the video and make 1 page format of 4 columns: particulars, schedule number, amount, and amount. Pause the video and make these columns. I hope you all are done with the columns. Now, as I said to you, there are 3 parts of revenue account. So right now we take up with the first part. And in first part, we show 3 major incomes. So write down in this format, everyone, premiums earned. First major income was premium. Within that, all of you write down premium as per schedule number 1. Premium will come in schedule number 1. Means the details of first year premium, renewal premium, single premium will be shown in schedule number 1. In that, we will minus the reinsurance ceded and plus the reinsurance accepted. This I told you in reinsurance itself. Wherever the word ceded comes, you will minus. Maybe it is premium or commission or claims, but wherever ceded word comes, you will minus. Accepted word comes, you will plus. So major income, premium. Now second, what did we study just now in the previous page in the chart form? 3 major incomes, premium. Then second, income from investment. So income from investment will include like interest, dividend, and rent. Gross. Now here, what does the word gross means? Before deducting TDS. Gross amount will be shown, means will be shown before deducting TDS. Tax is a different expense which you have to pay. Your major income will always be considered before deducting TDS. So if your income is 10,000, TDS of 3,000 is deducted and you receive 7,000 in your hands. Your income is not 7,000, it is 10,000, and 3,000 you have paid as tax to the government. So when you count your income, you will not include 7,000. You will include 10,000 before deducting TDS. Okay. So here the word gross means before deducting TDS. Then other incomes from investment like profit on sale or redemption of investments. And just like banking chapter, here also, if there is any loss on sale or redemption of investments, we'll show it as a negative figure in income from investment itself. Okay, loss on sale or redemption of investment will be shown as a negative figure in income from investment itself. Transfers or gain on revaluation or change in the fair value, and other incomes to be specified, like we studied in the terms today, consideration for annuities granted would be showing other incomes. So any other incomes would come in the category of other incomes, but you remember that first part has three major incomes: premium, income from investment, and other incomes. Schedule is to be made only for premium. Other items we directly show in revenue account. Now going further, total of A. So total of this first part of revenue account will be called total A. Now second part of revenue account, okay, three small expenses. You all remember which three small expenses? Write down. Commission. That will be as per schedule number 2. Schedule 1 we will make for premium. Okay, we discussed that only 4 schedules are to be made for revenue account. First schedule for premium, second for commission. Now which three small expenses after commission? Operating expenses related to insurance business, schedule number 3. Third schedule we will make for operating expenses related to insurance business. Which three small expenses? Third was provisions. So provisions like provision for doubtful debts, bad debt reserve, bad debts written off, provision for tax, and provisions other than tax like provision for diminution in the value of investments and any other provisions to be specified. So you just remember first part will include three major incomes: premium, income from investment, other incomes. Second part will include three small expenses: commission, operating expenses, and provisions. Total of the second part will be called as total B. Wherever required, you can pause the video and write down the things in your notebook. Okay, the total of second part will be called as total B. Going further, third part. Now third part includes three big expenses. Which three big expenses? Benefits paid. Benefits paid means it will include claims, annuities, surrenders. Okay, all this we studied in the terms also. So benefits paid will include claims, annuities, and surrenders as per schedule number 4. First schedule and workings in detail we have to make for premium. Second schedule and notes we have to make in detail for commission. Third schedule and notes in detail we have to make for operating expenses. Fourth schedule and notes in detail we have to make for benefits paid. So benefits paid will include this claims, annuities, and surrenders. All of it are done in your notebooks. Then which three big expenses? Bonus. So bonuses like interim bonus, bonus in reduction of premium, reversionary bonus. All these bonuses will be shown in the third part. And change in the valuation of liabilities in respect of life policies. I told you, actuary will make the estimate of liability that in next year how many people are going to die. So what we will always be doing is closing minus opening. If it comes positive, write positive. If it comes negative, write negative. So if opening liabilities was, let us say, 50 lakhs and closing liabilities are, let us say, 60 lakhs, means 10 lakhs of more expenses expected in the next year, will keep a provision for that. So automatically closing 60 minus opening 50, 10 lakhs of positive expense will remain. And if opening was 50 lakhs, closing is 45 lakhs, means your liabilities have reduced. So because of that reduction in liability, your income in current year will increase. So automatically the amount will appear as negative over here. So you just remember, whenever change in valuation of liability comes, you will do closing minus opening. If it comes positive, write as positive. If it comes negative, write as negative. We'll get the total, that is C. So three major parts are done. Now surplus, that is D, would be equal to A minus B minus C. A, major incomes, minus B, small expenses, minus C, major expenses. And after that we will show appropriations. Appropriations means whatever amount is transferred to shareholders' accounts and reserves, and remaining balance carried forward to balance sheet. So this is the complete format of revenue account. Now all of you take out your study material and schedules. We will see 4 schedules. We will see in detail from your study material. No need to write it in your notebook. Directly see from your study material what are the 4 schedules in detail. Page number 5 of your study material, you'll find schedule 1, that is premium. So what will we show in premium? First year premium, renewal premium and single premium. Then schedule 2, we will show commission expense. What all will you show in commission expense? Commission paid for direct business, which will again include commission on first year's premium, commission on renewal premium and commission on single premium. In that you will add commission on reinsurance accepted. All of you underline the word add and accepted. I told you in the reinsurance part itself, wherever ceded comes you will minus, wherever accepted comes you will plus. So underline the word add and accepted and underline the word less and ceded. Less commission on reinsurance ceded. Net commission. Note the profit or commission, if any, are to be combined with reinsurance accepted or reinsurance ceded figures. As we discussed, accepted you will add and ceded you will minus. Look at page number 6 of your study material. You will find schedule 3, that is operating expenses related to insurance business, employees remuneration and welfare benefits, that is salaries and wages, travel, conveyance and vehicle running expenses, training, rent rates and taxes, repairs, printing and stationery, communication, legal and professional charges, medical fees, auditor's fees, expenses as an auditor, as an advisor for taxation, insurance and other management services in any other capacity, advertisement and publicity, interest and bank charges, others to be specified and depreciation. So all the normal expenses related to insurance business will come in operating expenses. And same page number 6, all of you look at schedule 4, that is benefits paid. Benefits paid, I told you 3 things will come in that: claims, surrenders and annuities. You remember only that much. Insurance claims, claims by death, claims by maturity, annuities or pension payments and other benefits like surrenders. In other benefits you can mention surrenders. Amount ceded, underline the word ceded and write minus. Ceded we will minus. Within ceded, whatever are the claims by death, maturity, annuities and surrenders we will minus. And third point, amount underline accepted we will plus. So whatever is the amount accepted in case of death, maturity, annuities or surrenders we will plus. So you just remember ceded we will minus wherever it comes and accepted we will plus wherever it comes. Claims include the specific claims settlement costs also wherever applicable. So if specific claims settlement cost is given, we'll add it in respective claim. And legal and other fees and expenses shall also form part of claims cost wherever applicable. So legal expenses related to claim will not be shown in operating expenses. Legal expenses related to claims will be added in claims itself. I repeat, legal expenses related to claims will not be shown in operating expenses. Legal expenses related to claims will be added in respective claims itself. Okay, so this completely covers with the format of revenue account with each and every schedule in detail. Now in the next lecture we will start with the practical questions related to revenue account of life insurance company. That will be all for this lecture. Bye everyone. Take care. See you in the next lecture, and by that time make it sure that you all remember and learn by heart the format of revenue account of life insurance company. Bye. Take care.